Hello friends, welcome to the channel Way to Treasure. I hope everyone is doing great. So in this video we are trying to understand how to get a better loss to profit ratio using the strategies or the ways that we have in stock market. Okay, let's go into the topic. So as the heading suggests, strategy to choose for trading an opportunity. So we have picked a set of strategies where when you see an opportunity, when you see a trading opportunity, how you can trade the same. So from this, like, we can choose which is the best choice to pick from the available ways to trade an opportunity. The available ways to trade for a breakout are either you can buy shares, you can buy a call option, or you can sell a put option. So in options, right, like if the selling premium is more than the buying premium, then you'll make profit. Okay, so I hope like you guys know that. So I have a trade called Adani Enterprises. This is the screenshot of 10th of or 9th of November, I guess. So this is breaking. Adani Enterprises is breaking out of a channel pattern. So this is what I understand. So I feel like 1630 to 1635 is where Adani Enterprises try to break out. So let's consider this stock and see like how we can trade. So as I said, like buying a call option and selling a put option are the other two ways than buying shares. Is the way that where we can trade. So if you see the margin required when you to sell an opportunity is 2,10,000. So I consider the capital as 2,10,000. So for 2,10,000, if you buy shares, you will get somewhere around 128 shares. And in both the options, either in call option or put option, I choose out of the money options. I mean, the reason behind choosing the out of the money options is like the premium will be less, so that even if my view is wrong, loss will also be less than the at the money or in the money options. So as you see, to buy a call option, I choose 1660 strike price and it is at somewhere around 151.8. So let's consider for a easy calculation, let's consider it as 52 rupees. And to sell a put option, the premium is somewhere around 25.5 rupees and the strike price is 1560 put option. And the reason is same. I mean, I choose out of the money put option. The reason is same as I suggested before. And here I'm selling this put option, so here I'm receiving the premium of around 25.5 rupees. Now let's see on the expiry. By the currently we are in November expiry, so every month last date is the expiry for the stock options. So let's by the end of this expiry, let's think that the share has moved somewhere around 5%. So 5% from 1635, that makes to 1715. So the share would have raised it to 1715. And I mean, as it moved by 5%, if you buy shares, the profit will also be almost the same percentage, because from 1635 to 1715 is 80 rupees profit, and you have 128 shares, and the profit will be 10,240. And the call option will expire at somewhere around 55 rupees, right? Because you know the calculation, right? Like if you don't know how to, I mean, how I have calculated this 55 rupees, please do let me know in the comments. I will prepare a separate video on how to calculate the value of a strike price of whether it is in the money or out of the money strike price and its value by the time of expiry. I'll make a separate video on that. Please let me know in the comment. So now 1660 call option has become 55, and we bought it at 52. So the profit will be 3 rupees, and this is the lot size. So now the profit will become 1500 rupees. Okay, and 1560 put option is an out of money put option, so this expires at somewhere close to zero, and the profit is whatever the premium that we have collected is the profit into the lot size, so the profit comes around 12,750. So we can never say that whatever our vision or whatever our view is always right, like it may also go wrong. So let's see, like what if it goes wrong and it moves 5% down. So if Adani Enterprises close at 5% down, then the share price will become 1550, and the loss will also be same. 80 rupees is the loss, and 10,240 is the final loss that we get by the end of November from the shares. And 1660 call option is an out of the money, is an OTM option, and all the OTM options at the expiry will become zero. And now the loss is whatever the premium that you have paid. So now the loss is 52 rupees into the lot size. So the total loss comes around 26,000 rupees. And 1560 put option will become in the money put option, and it expires at 10 rupees. As we have collected a premium of 25 rupees, so we sold at 25.5 rupees, and we are buying now at 10 rupees. So I mean, the difference is 15.5, which is our profit. See here, even though the price moved downwards, I mean, your even though your view is wrong, here you're in this put option you are making some profit. So that is around 7,750 rupees. Now if you find the ratios of profit is to loss when you buy I mean, in whatever the way that you follow, then you will understand like how much amount are you risking to earn how much amount of money. So here it will be, I mean, while buying shares, like it will be identical, so that everyone knows. But in the call option, to earn 0.7% of money, you are risking somewhere around 12% of your capital. Right, the capital is 2,10,000, that's what we have fixed it. But for buying a call option you use only 26,000, but still that is from the capital of 2,10,000. So to earn 0.7%, you are risking somewhere around 12% of the money. Whereas in selling a put option, when your view is right, you earn 6%. When your view is wrong by 5%, you earn 4% as an interest, or as a profit. So you can now you can here itself, like you can see like how the difference has been, like how much percentage of amount you are risking to earn a particular percentage of amount if it moves somewhere around 5%. So similarly, if there is a move of 7% up move, then the share will become 1750, and the call option will become 90 rupees. The profit is around 38 rupees, as we have already bought at 52 rupees premium. Now the premium has become 90 rupees, so the profit is 38 rupees, and when it calculated with the lot size, then the profit will become 19,000. Similarly, 1560 put option is an out of the money option, so it expires at zero, and the profit is 12,750. And if the share price is down by 7%, then it will move to 1520, and the loss will be identical. So there is a loss of 7% in capital, and 1660 put option will expire at zero, and the loss will be 26,000. And 1560 put option expires at 40 rupees. As you received 25.5 already while selling the option, now the loss will be extended to 14.5 rupees. When it multiplied with the lot size, it will be, the loss is 7,250. Now if you see the ratios of buying a call option and selling a put option, to earn 9% in to earn 9%, you are risking 12% of amount of your capital. Whereas in selling a put option, even though your view is quite wrong, because like 7% move is not a small move. It is considered as a in a month, or I think like we have around 2.5 weeks, or maybe like around 3 weeks. So in 3 weeks, like if you are moving, if your share price is moving by 7%, is very close to multifold returns. So you say multi-bagger when it comes to the yearly returns, right? Like for a month, if you are getting somewhere around 7% move, is nothing less than a multi-bagger. So you are getting a multi-bagger returns, but still you're risking just 3% of the money to earn 6% of the capital. So what I'm trying to explain you here is, so selling a put option when you see an opportunity, or it can be selling any option, will give you more profit is to loss ratio when it compares to buying a call option or buying shares. So as I'm explaining here, a breakout opportunity where we are seeing that the price goes up, I bought a call option and sold a put option. But when you see a reverse direction, when a company's share price is going down, then to make money you can buy a put option and sell a call option. So what I'm trying to explain is like, where whenever you see an opportunity, selling will give you more profit, and profit is to loss ratio even your view is wrong. So I want to explain one more thing here. So here you have one more benefit while selling the opportunities. I mean, while selling any option. So this can be decided watching two parameters. One, if there is no theta to decay, then close the current holding option, and then you can sell a higher strike price. So if you don't know, if you want to know how to check the theta value, please let me know in the comment section. I will make a separate video on that. So the second way is to for every for move the strike price by Y% every time whenever the stock moves by X%. So that means like if a stock price moves by 7%, then move the strike price up by 2% or 3%. So now you see that like our stock has moved from 1635 to 1750. 1635 to 1750. Then you can move your 1560 put option to somewhere around 1600 put option. So this way you can only use when selling the options, like this will be benefitable only while selling the options. This cannot be, you cannot use this trick to buy options. So because like that may extend your losses, but here this will definitely extend your profits. You can once try this, so that like you'll get how you're enhancing your profits. So, and if you want to know like why this cannot be used in buying the options, you I mean that will become a topic for a different video. If you want to know, do let us know in the comment, so that we'll try to make a video as soon as possible. Thanks for spending your time in this video. If the content is good, please like and share it to your dear ones. Please subscribe to our channel to encourage us. Bye bye, and we are on our way to find the treasure.